Good afternoon, everyone. My name is Emilio Escandon. I'm the managing principal of MBAF's 2 New York offices, and I'm also a tax principal at MBAF. On behalf of the entire MBAF team, I would like to welcome everyone listening to our Paycheck Protection Program Loan Forgiveness Roadmap webinar, and a special thank you to our clients and friends. Joining me today are 3 of our colleagues. Joining me from just north of me in Westchester County is David Evangelista. David is a consulting principal in our Valhalla office who specializes in closely held businesses, professional services, and high net worth individuals. Joining me from South Florida are Jordan Argiz and Maggie Reach. Jordan is an audit director in our Miami office, specializing in auto dealerships, wholesale and distribution, and sports and entertainment. Maggie is a tax manager in our Coral Gables office, specializing in complex partnership taxation matters, tax accounting methods, and transaction-related restructurings. David, Jordan, and Maggie are members of MBAF's PPP Loan Advisory Team and have been spending the last 4 weeks collaborating with the team in researching and analyzing all aspects related to PPP loans, as well as developing calculators and participating in a number of client conference calls. Let me take a moment to introduce today's agenda. David is going to provide a brief PPP refresher and cover some recent new guidance. Jordan will be reviewing the rules regarding loan forgiveness. Maggie will do some heavy lifting, walking us through the loan forgiveness reduction calculations. And David and the team will then wrap up the program going over some questions that are still chasing down answers. Please submit questions in the Q&A section of the control panel. If we do not address them during the webinar, we will reach out to you after the webinar. Before turning it over to David, 2 additional administrative points. We will be sending a follow-up email tomorrow, which will include the presentation slides and the on-demand webinar. This email will also contain a link to the entire library of MBAF's CARES Act and PPP loan related advisories. We are offering 1 CPE credit for this webinar. If this applies to you, please participate in the 3 polling questions that will be asked during the webinar. We will distribute the CPE certificates by tomorrow. And now I will transition over to David. David?
Thank you, Emilio. Good afternoon, everyone. So the first thing we're going to talk about to kind of get us queued up for the meat of the presentation, which is going to be about forgiveness, is just some current events revolving the program, and then a little refresher about the application and the front end of the process. So we're going to start with these new developments. So first of all, hopefully everyone has seen or knows on Tuesday, the Senate approved some additional funding to further enhance the CARES Act, about $484 billion in additional funding. That includes some money for testing, hospitals, healthcare, but also $310 billion to supplement the PPP loan program, which has actually run out of money in its first tranche. $60 billion of that is actually going to be allocated to smaller lending institutions to help to get money to the smaller, medium-sized community businesses. And then they actually allocated another $60 billion to the EIDL program, which also ran out of money. That'll be $50 billion available for EIDL loans, and then another $10 billion allocated for the grants. On my end, I don't see the next slide, but hopefully we'll get it to advance on your screens. There we go. So I also want to touch a little bit on some recent guidance. Up until a few minutes ago, this was the most recent guidance. I'll get to that in a minute. But on April 14th, the SBA came out with some guidance. It actually clarified 2 areas that were causing a lot of grief in the process for people. The first one is about partners and partnerships. Originally, there was some discrepancy about how a partner or partnership would apply. Could they apply on their own as a self-employed? The guidance that just came out April 14th says that the partners in a partnership have to be included at the partnership level into a single application. And that was kind of to streamline the process. They didn't want a lot of individual partners applying on their own and clogging up the PPP application system. The second thing they clarified with that guidance was for self-employed individuals. That you have to use your 2019, the amount that's going to be if you haven't filed, or if you have filed, what your net income on your Schedule C is going to be. You can't add things like you can for employees. You cannot add a self-employed person's health insurance or their pension or retirement. The only ones you can add is if you have employees for your Schedule C and you take deductions on your Schedule C for the employee's health and the employee's retirement. Those you can include in the employee payroll cost. There was some guidance came out just afternoon today, right before while we were getting ready to go on with the webinar. We actually hoped that would be the guidance everyone's looking for on forgiveness and answer all the questions we have throughout the presentation. But actually that guidance that just came out today was still on the front end. It's still covering loan applications. So basically, as of right now, there's still no specific guidance issued by Treasury or SBA on the actual loan forgiveness. But we're going to walk you through what we know and what we think the guidance will be and point out some areas where we're hoping for future guidance. So let's just talk about what the program was real quick. So the program was designed to keep paying employees. So you have to kind of remember that concept through this whole webinar. The intent was to keep paying employees. It was geared for smaller businesses, less than 500 employees. That's why it's called the Paycheck Protection Program or Paycheck Protection Loans. You have to meet certain conditions. You do certify. Anyone who has applied is on the webinar and done your application. You certify. You actually sign an initial and answer certain questions that you're going to meet the conditions and that you're going to use the expenses, and this is very important, that you're going to use the expenses for the allowable uses, right? And we'll talk a little bit more about that later. So who is eligible? Businesses with basically less than 500 employees, except that there were some exceptions for certain type of franchise businesses and certain types of businesses who are still considered small under the SBA rules, even though they may have more than 500 employees, but they actually may have under a threshold for revenue or assets. And then with that, I think the screen may be a slide or so behind, but if we go one more, please. So there was a maximum amount of the loan. There was a calculation that you had to do with the loan application. It was either 10 million was the max, or you were limited, a lower limit to this monthly payroll cost, this average monthly payroll cost, most people based it on their 2019 payroll, multiplied by 2.5. And you could add to that if you had previously received a EIDL, you could refinance your EIDL into the Paycheck Protection Loan. So those are kind of the limits and what the program was. So now to queue up the rest of the day, I just want to talk a little bit about what you could use the loan. So in the Act, there's actually, and in all the Q&As, there's a differentiation between the application, loan proceeds, and forgiveness. There's a middle section that gets a little overlooked, and that's what you could use the loan proceeds for. So there's certain things you can use it for. As we go through the presentation, Jordan will talk about it. You can get forgiveness on some of these, but maybe not all of them, and some of them need clarification. So you see things like payroll costs, that was the intention. There's a little bit of discrepancy right now on, I kept paying my health insurance for my employees. That's fine, it's allowable use, but can I really put it into my forgivable expenses? We're gonna have to get a little clarity. Some of the other things, the interest on mortgage obligations, that's a definitive statement in the Act, interest on mortgage obligation. Rent, utilities are going to count as non-payroll costs. But that last bullet we have up there right now is really one of the areas that we need further guidance. You can use the money, you can use your proceeds to pay interest on other debt obligations, things like lines of credit, car loans, equipment loans, things that are used in your business. But the way it's written right now, when we get to forgiveness, you'll see it in a couple slides. For forgiveness, it's only going to be that middle bullet, payments of interest on mortgage obligations. So right now it's uncertain at best whether we'll be able to use that other interest for the non-payroll costs. So, but Jordan will talk about that when he starts going through forgiveness. But right now I think I'm going to kick it back to Emilio for a second.
Okay, thank you, David. We'll go to our first polling question. Let me read it. Regarding the applicants that I work for or represent, the applicant has received PPP loan funding already. The applicant has been approved and has been assured by the lender that the applicant will receive funding shortly. The applicant has applied but has not been formally approved, or other. And while we wait for the questions to arrive, and David, I guess one thing that some people are confused about and that you've clarified a little bit is that just because an expense qualifies as an allowable use of the loan proceeds, it does not automatically guarantee that it will qualify as forgivable. Is that correct?
Emilio, you just touched on a very important point. That's exactly right. Just like I mentioned, you kind of put allowable uses on one side, which I just went over, and on the other side, forgivable expenditures, things that are going to be put in the pots before we start calculating what's forgivable. And they may not line up exactly dollar for dollar. So you're going to have to be a little careful there and differentiate them.
Okay, thank you, David. Here are the results of the poll. Wow, 57% have already received their funding. Excellent. So we've got quite the engaged audience listening in. So, okay, Jordan, I'm going to pivot to you. Take us through the loan forgiveness rules.
Thanks, Emilio and David. I'm going to talk a little bit about here the loan forgiveness and the different costs of payroll costs and non-payroll costs, how they're defined and how they can be utilized for forgiveness. So I think David had mentioned before, but the CARES Act allows for all or a portion of the PPP loan to be forgiven. And that portion of the loan that is forgiven is not includable in your federal taxable income for 2020. And the forgivable amount of your loan is equal to the amount the borrower spent on eligible costs during the 8-week period, beginning on the date that you received your loan funding. So the day the money comes in, that's when the clock starts ticking for these 8 weeks. And we're calling that the covered period. It's going to be referred to. And not more than 25% of the forgivable amount may be used for non-payroll costs. And before I get into some of these eligible costs, I just want to, again, stress the difference between this slide and the previous one that David was covering. This slide covers the allowable uses that are eligible for forgiveness, whereas the one that David covered is just the allowable uses of the PPP loan proceeds. And in general, these eligible costs, which are eligible for loan forgiveness, are a subset of the allowable uses in the previous slide with, slight nuances and things that, may not be included here that were included before, such as, the debt that he mentioned on other debt obligations. So these eligible costs, again, eligible for forgiveness, are payroll costs, including benefits, payments of interest on mortgage obligations incurred before February 15th, 2020, rent payments on lease agreements in force before February 15th, 2020, and certain utility payments for which service began before February 15th, 2020. And here we'll talk about the payroll costs and what they're defined as. So at least 75% of the forgivable amount must be spent on the following payroll costs during the covered period to be eligible for forgiveness. Gross salaries, wages, tips, and vacation, parental, medical, or sick leave if not credited under the Families First Coronavirus Response Act. Maximum of $15,385 per individual. That's $100,000 divided by 52 weeks times 8. And then plus healthcare expenses, retirement contributions, and state unemployment taxes, and other state employer payroll taxes. So going on to the next slide for non-payroll costs. Proceeds spent on the following non-payroll costs are eligible for up to 25% loan forgiveness. Notice the difference here on up to 25% and the previous one being at least 75% for payroll costs. So the non-payroll costs are defined as rent payments on pre-February 15th, 2020 lease agreements, mortgage interest payments on pre-February 15th, 2020 loans secured by real or personal property. So something to note on this item, conventional mortgages usually include real estate, but this does mention personal property. And, we are seeking further guidance on what constitutes personal property. Does that mean if you have a line of credit secured by inventory, would the interest for that be subject to forgiveness? And again, we don't have a clear answer on that. We're expecting guidance to come out. There's been questions that have been put to the SBA and the Treasury on this topic. And lastly, the utility payments under pre-February 15th, 2020 service contracts. And included in there is electricity, gas, water, internet, telephone, transportation, etc. So on the next slide, we'll take a look at an example of this 75-25% split. On April 10th, 2020, ABC Inc. received the PPP loan in the amount of $1 million. And payroll costs for the 8-week covered period consisted of the following: salaries, wages, and paid time off of $465,000, which is limited to the annualized salaries of $100,000 per person, which is at the $15,385 mentioned earlier per individual. Healthcare expenses of $150,000, retirement contributions $75,000, state unemployment insurance $10,000. So total qualifying payroll costs are $700,000. Now, when you got your loan that was $1 million, you take 75% of that. You should be spending at least $750,000. However, you only hit $700,000. So the total eligible for forgiveness of your payroll costs is the $700,000. And ABC also paid non-payroll costs of rent expense of $150,000 and utilities of $50,000. So your total qualifying non-payroll costs are $200,000. Calculated maximum non-payroll cost to be forgiven would be the $700,000 divided by 75% times 25%, which is $233,000. So in this example, the entity would have a forgiveness amount of $200,000 related to non-payroll costs and the $700,000 for payroll costs. If the total qualifying payroll costs were $900,000 and qualifying non-payroll costs were $200,000, the total cost eligible for forgiveness would be the entire loan amount of $1 million. The total cost forgiven cannot exceed the loan amount. Said another way, if you spend 100% of your loan on eligible payroll costs, the entire loan amount will be forgivable. Because again, the payroll protection program is to have employees put money into the pockets of their employees. So there's nothing wrong with spending all of the money on payroll costs. You're just limited to the amount of non-payroll costs that you could spend.
Thank you.
And with that, I think
Thank you, Jordan. Thank you. We're whizzing right along. It's time for our second polling question. I have a couple follow-up questions for Jordan. And there we go. All right, what is your number one priority for the PPP loan proceeds? Get as much forgiveness as I can, bring back as many people to work as I can, preserve the cash for future permissible expenses, and pay off the unforgiven loan amount, or some or all of the above? Jordan, I think David covered this, and I think most of our listeners are aware of the math involved in coming up with the loan proceeds, and that was purely based on the average payroll costs. But the guidance at that time in arriving at average was a monthly approach, and then you multiply that times 2.5, and now it seems that for purposes of forgiveness, there's been somewhat of a downshift. And rightfully so, that the math works out to be, 8 weeks over 52 weeks. But it's obviously quite the haircut off of that average amount. Having said that, is this going to make it that much harder or that much more difficult to achieve 100% loan forgiveness?
Emilio, you bring up a good point, and obviously there's somewhat of a conflicting message here. For example, if a company has one employee that makes $100,000, for the forgivable uses of that employee, you take 100,000 divided by 52 times 8, and you come out with that, famous 15,385 we've mentioned a few times here. But, when you applied for the loan, the payroll portion, take 100,000 divided by 12 times 2 months, which, should be those same 8 weeks, and it comes out to a higher number, 16,666.67. So the computation as it relates to payroll costs used to apply for the loan results in a higher number than, the computation used for the forgivable use of the loan. It's, a problem in the way that this is written. So I think what we're advising people is, if your goal is to maximize loan forgiveness, we recommend spending as much as you can on these payroll costs, even if that means paying somebody more than you had previously paid them before, before you went into maybe a shutdown or furloughed situation or operating at limited capacity.
Agreed. And to address some of the questions that are coming through right now, it doesn't seem to be a limitation on hiring new employees in order to get that maximize that spend during the 8-week period to get as much forgiven as possible. Is that correct?
Yeah, that's correct. And I think, towards the end of the slides, we have some questions that, Q&A that we're going to address some of those and some ways to get around this, if you will, to maximize that loan forgiveness.
Okay. Showing now the poll results. You see that the bulk of our listeners are in the some or all of the above, which is expected. So interesting data coming in, and only 3% are trying to preserve cash. It seems like our listeners are active employers trying to keep their people employed. Okay, so speaking of potential reductions to the amount qualifying as forgivable, let me now turn to Maggie, who has some interesting illustrations to share with us. Maggie?
Thank you, Emilio, and thank you to everyone for joining us today. Now that Jordan has covered what the Paycheck Protection Loan proceeds can be used for and the forgivable uses of payroll and non-payroll costs, I'm going to discuss the loan forgiveness reductions. So there are 3 important reductions to discuss today. The first is a salary and wage reduction and is based on each employee's individual pay level during the 8-week covered period. The salary and wage reduction applies to employees that earn less than $100,000 of annualized wages during any single pay period in 2019 and whose wages were reduced in excess of 25% during the covered period. So the reduction is how much wages were reduced in excess of 25% compared to the most recent full quarter's annualized salary. So in other words, if an employee made 74% of their salary in the 8-week period compared to the most recent full quarter, the reduction amount is going to be 1% of the most recent full quarter's salary. And we're going to have an example in the next slide to illustrate the mechanics of this calculation. If you can go back a slide. As you can see from this chart, the forgivable amount that Jordan discussed, consisting of payroll costs, mortgage interest, rents, and utilities, is reduced by the salary decrease that went down by more than 25% for any employee making less than $100,000, less than $100,000. Therefore, the forgivable amount after the salary and wage reduction is calculated. And here's a caveat. If the employee's wages are fully reinstated by June 30th, 2020, then the salary and wage reduction is waived. There's still more guidance to be heard on this, but for now, we're sticking to the June 30 date. On the next slide, we'll go over an example. John Seymour is the only employee of ABC Inc. Okay, so for purposes of this example, John's annualized salary in the most recent full quarter, i.e. Q1 2020, is $25,000. His annual salary during the covered period is $17,500. So how do we calculate the forgiveness wage reduction? We take his annualized salary in the most recent quarter of $25,000 and multiply it by 75%. We subtract from that amount his annualized salary during the covered period. Therefore, the entity will have a forgiveness reduction of $1,250 related to John's reduction in salary. I want to make 2 points on this slide, and one is that his salary in the most recent full quarter must be annualized, and the salary in the covered period must also be annualized, because there's 13 weeks in a quarter and 8 weeks in a covered period. So to compare apples to apples, you need to annualize. And lastly, we can look at this another way. We can say that John effectively earned 70% of his wages during the 8-week period compared to the most recent quarter. Therefore, the salary and wage reduction is 75% less 70, or 5% of 25,000, which is exactly 1,250. The next reduction is the full-time equivalent workforce reduction. The concept behind this reduction is to make sure employees keep their workforce sustained or intact during the 8-week covered period. The most important element in computing this reduction is something called the full-time equivalent employee that I'll go over in the next slide. There are two options available in computing the average full-time equivalent employee per month for the denominator, and they are elective only if you are not a seasonal employer. I just want to reiterate the most important thing to remember in this computation is that you can choose the lesser of option 1 or 2. It is elective. The lesser of option 1 or 2 is the most beneficial and will maximize the forgiveness amount because it's your denominator. Just remember, the larger the fraction here, the more that can be forgiven. So let's go over these two options. Option 1 is the average number of full-time equivalent employees per month employed during the period beginning February 15th, 2019 and ending on June 30th, 2019. Option 2 is the average number of full-time equivalents per month employed during the period beginning on January 1st, 2020 and ending on February 29th, 2020. Those are your denominators. The numerator is the average number of full-time equivalents per month during the covered period. I want to also note at the bottom that if the work, similar to the salary and wage reduction, if the workforce is reinstated by June 30th, then the workforce reduction is completely waived. It's unclear, however, what the reinstatement on June 30th will be compared to, but for now, it's easy to say you can compare it to how many employees you had as of 2/15/2020. So let's define what this term full-time equivalent employee, or FTE, is. Unfortunately, an FTE is not defined in the CARES Act, but it is defined in historical SBA guidance. FTEs are employees working at least 30 hours per week. Part-time employees can count as a full-time employee equivalent based on the aggregate number of hours they worked in each week or each pay period. So let's walk through an example on how to calculate FTEs for a biweekly pay period. In this example, there are 50 full-time employees because they worked at least 30 hours a week. The part-time employees worked a total of 450 hours during the pay period, and the pay period for a biweekly payor or employer is 2 weeks. So we divide 450 by 60, and the result is 7.5. That means that the part-time employees count as 7.5 full-time employee equivalents. Continuing this example, it also assumes that the FTEs are the same for each of the 4 pay periods. So we're assuming that there are 57.5 full-time equivalent employees for each pay period in the covered period. So how do we annualize this and get a monthly average? We take 57.5, multiply it by 26 pay periods in 2019, and then divide it by 12. So our monthly average full-time equivalent employees during the covered period, 8-week period, is 124.6. And that's our numerator. The same calculation needs to be done for options 1 and 2 that I discussed before to complete the workforce reduction. So let's go to the next example and how this all will play out. We'll tie it all together. So here are our facts. The borrower determined that using the average number of FTEs per month for the period from February 15th, 2019 to June 30th, 2019 was most advantageous. So they chose option 1. The loan amount they received was $1 million. And similar to Jordan's example, the entity spent $700,000 in payroll costs and $200,000 in non-payroll costs during the covered period. Therefore, $900,000 was spent from the total proceeds and $100,000 is not eligible for forgiveness. We already know that the entity had $15,000 of salary and wage reductions, and that one full-time equivalent employee is equal to 30 hours a week. So our average number of FTEs from option 1 is 105, which is our denominator, and our numerator is 85, which is the average number of FTEs during the covered period. So our forgiveness ratio is the quotient of those two numbers, 85 over 105, or 81%. Our minimum payroll costs to be forgiven are $700,000, which is the max we spent on payroll costs in this example. And then the maximum non-payroll costs, as Jordan mentioned before, is taking the minimum payroll costs to be forgiven, divided by 75%, and multiplying it by 25%. So this employer could have spent $233,000 on non-payroll costs, but in fact, they only spent $200,000. So we take the lesser of. To calculate the workforce reduction, we sum the forgivable eligible costs, which are $700,000 in payroll costs, $200,000 in non-payroll costs, less $15,000 in the salary and wage reduction, and multiply it by 1 minus the forgiveness ratio. So the workforce reduction is going to be $168,000 and $150. If we continue through the math, we can see that the amount eligible for forgiveness is going to be $700 plus $200,000 minus $15,000 minus $168,150. So out of the $1 million of proceeds, $716,850 is eligible to be, can be forgiven. And the entity will be required to pay $100,000 plus 15 plus 168 of the loan amount plus interest. It is unclear the ordering rules of these two reductions, but we are applying the workforce reduction after the salary and wage reduction to prevent a double dipping effect on total payroll costs. And we still need more guidance on that, but that's our interpretation. Okay, so far we covered 2 of the 3 possible reductions. Now let's visit the last reduction, which is far less assuming and easier to compute. If you received an economic injury disaster loan grant, or commonly referred to as an EIDL grant, you must reduce your forgivable amount by the amount of the grant you received. Let's talk about the loan forgiveness process. We're expecting that there will be a formal loan forgiveness application to be submitted to the lender. We want to note that loan forgiveness is not guaranteed even if the requirements have been met. Similar to the loan application process, it's up to the lender's discretion based on documentation and certifications received from the borrower. Also important to note that a lender will not be penalized by the SBA if they reject a borrower's loan forgiveness application. After submitting a loan forgiveness application, the lender has 60 days to make a decision on forgiveness. SBA guidance has offered us documentation for eligible costs that must be submitted to the lender when completing the loan forgiveness application. It includes a Form 941 and state quarterly wage unemployment insurance tax reporting forms or payroll processing records. This is for the payroll costs. For the non-payroll costs, you can submit copies of leases, business mortgage interest statements, and business utility bills to substantiate the costs in the 8-week period. In the event you find yourself at the end of the 8-week period looking at little to no forgiveness, the unforgiven portion of the loan plus interest must be repaid within 2 years. PPP loans carry a 1% interest rate with loan payments deferred for the first 6 months. There's also no prepayment penalty, which allows you to repay the loan at any time before maturity. I believe we have a polling question, and I'm going to turn it back over to Emilio.
Okay, let's bring up that polling question. This is the third and final polling question. Do you feel that the SBA and/or Treasury must provide more guidance on loan forgiveness as soon as possible? No, I pretty much understand everything. Yes, in certain areas. Yes, in many areas. I'm still so confused. While we wait for the answers to come in, let me go back to Maggie. Maggie, you mentioned the uncertainty with respect to the ordering of these forgiveness haircuts. As illustrated in example 3, MBAF's approach is the one that we think results in the most favorable answer to the applicant and or our client. And the hope is that the congressional intent was not to penalize or try to force as much of a loan on the small businesses, but quite the contrary, to provide for as much forgiveness as possible. Given the uncertainty, is there anywhere in either the Act or the SBA IRS guidance that you could point to that provides some clues as to what the ordering may be?
Yeah, absolutely. We know in the CARES Act that the FTE and workforce reduction appear before the salary and wage reduction, but they appear to be mutually exclusive. So we can't just say just because one is before the other in the CARES Act that is the order that they should be applied in. The limit of no more than 25% of loan forgiveness being attributable to non-payroll costs was not in the CARES Act, but it was introduced in the SBA's interim final rules on April 2nd. So to be honest, we just don't know for sure until they release the additional guidance, and the guidance they released today doesn't help. So it's a waiting game again.
Okay, very interesting analysis, Maggie. Let's see what the answers came in as. All right, well, it wasn't as bad as I thought. Not very minority of the majority is not so confused, and obviously everybody's waiting for additional guidance. All right, David, we have a pretty good amount of time to go through some of the questions, still looking for answers, and we'll probably have a little bit of time to cover some of the questions from our listeners. So with that, David, can you take us through slides 26 and 27?
Sure. Thanks, Emilio. First of all, just to update everyone, I started off talking about the additional $484 billion in funding. Just to keep everyone current, I was hoping we'd have an announcement before we got done with the webinar, but they're still wrapping up comments from members of the House. Voting is scheduled to begin shortly, so just you'll have to watch the news later to see whether the funding was approved. So we have these 2 pages of questions. We'll go through them and try to give some more guidance using these questions. In my mind, I went through all these questions and I thought there's really like 4 answers that would answer any of these questions. And the answers are good question, maybe, we are still unclear, or could change. So I'm being a little bit in jest there, but as I go through, you may hear me refer to something like that because there are a lot of areas on these questions where more guidance is going to be desired and needed. So we have these broken into 3 sections. The first section being revolving around payroll costs. So we talked a little bit before about incurred and accrued. And there is a difference, and the difference is going to be whether there's an or just an and in there, and about prepayments, how prepayments are going to be. If I pay something for beyond the 8-week period, can I bring that back in just because I paid it, even though it wasn't due yet? So we're certainly going to need a little more guidance, even if it's just a clarification of what and means. As we move through the next few here, I just want to remind everyone earlier in the presentation, we talked about the covered period. When we refer to covered period in the questions, is that 8-week post-funding period. So the next question, and Jordan touched on this on his slides, about the federal income tax, the payments being excluded, can we use the expenses and deduct them? We hope so. It would make a lot of sense to the intent of the Act, but there is an Internal Revenue Code section that currently deals with the topic of you have tax-exempt income and you pay expenses with tax-exempt income, you can't take tax deductions for those expenses paid for with tax-exempt income or to derive tax-exempt income. There's a fine line here, and again, we hope the guidance, kind of gives us more guidance and may take some Internal Revenue guidance. Is excludable, the way this is written, the same as tax-exempt, or is it really a different concept? Again, we do hope that people are going to get deductions for the items that were included in forgiveness. That's our hope. The next couple questions cover bonuses, bonuses paid during the period and back pay and things like that. So, can you pay bonuses during the period? Yes, and I'm going to go over it in these next couple questions. But again, anything paid during the 8-week period, you're going to have to annualize those payments to that employee to see whether they've gone over $100,000 on an annualized basis. So you got to keep that into account. You may want to run some scenarios if you're in any of these next 3 question scenarios here. The back pay or paying somebody in advance, again, we think so. If they're paid during the period, you didn't pay somebody and now you pay them because you got the money. That was the intention of the program. We believe that's going to count. And paying somebody in advance, again, it says paid, so we're hoping paid is paid. Can the bonus make somebody's salary exceed what was on the application? That's my first good question. So that is a good question. Nothing in the guidance talks about comparing the pay in the 8-week period all the way back to the application. The referral is for the wage reduction is simply to the last full quarter. So we don't really know, but nothing indicates that you have to actually tie the pay in the 8-week period back to the loan application pay. Again, another question regarding the bonuses to people making less than 100. And again, be careful of the annualization. I use the example of a $50,000 a year employee paid during the 8-week period. That employee in 8 weeks is going to make 50,000 divided by 52 is going to make about $7,700. The $100,000 limit annualized for the 8-week period is about $15,400. So the difference between $15,400 and $77,000, you could really only pay that employee a $7,700 bonus and have that count towards the possible forgiveness, because anything over that would put them over $100,000 annualized. And again, the period, this is a big question that comes up. My period kind of overlaps the end of the 8-week period. We're hoping for guidance. Same thing with the June 30th. We believe that 8 weeks is 8 weeks, and you're going to get 8 weeks to spend your money. So our presumption is that if you spend it in the 8 weeks, you're going to be allowed to use the money, and you're going to get forgiveness if it qualifies. So, and then the last question in that top section, Jordan and Emilio actually covered it when they were talking earlier about the how 8 weeks of payroll is slightly different from 2 months. But I did want to remind everyone again, on the application, you divide it by months, 12 months to get monthly, but on the back end for forgiveness, you're going to divide by 52 times 8 to get 8 weeks, and that is slightly different. So at this point, I'm just going to take a breather here and see if Maggie or Jordan have anything to add, regarding this pool of questions on payroll costs.
David, I have a comment on number 1, if I can jump in. Actually, number 2.
Sure.
Number 2. There's a school of thought, notwithstanding the case law that you alluded to regarding expenses incurred with respect to tax-exempt income. There's a alternate school of thought. A lot of practitioners think that if the ruling comes on, and this will probably be some kind of revenue ruling, although it could be handled in an FAQ. If the guidance comes along that says that those forgivable amounts are not deductible, there's a school of thought, and I think it's ground on logic and support. The disallowance of the deduction is akin to an income pickup. And so when you think of it that way, that runs contrary to having had the proceeds been excluded from income. Now, I know I'm kind of double talking here to a certain extent, but a disallowance of a deduction is the same as a taxpayer picking up the income. So I just wanted to add that into the conversation. I'll turn it over back to you, and maybe if Jordan and Maggie have something to share.
Yeah, I'll jump in. We're getting a lot of questions, obviously, from people here, over 200 now. And guys, we're trying to do our best to get to some of them. I'm trying to kind of gather what common themes there are. So I know a lot of people have asked, and David did cover this, but just to reiterate on the incurred and paid expenses, if you have out of period, we are waiting for further guidance on that. So, whether your expenses or costs are incurred and paid, if their intention really meant both of those things or either one, if you have a lapse in the period. So again, we're waiting for those to hear more clarity from the SBA on it. And a couple of other questions that, have come in, and maybe it's good for us to talk about is, let's say you're in a situation where your business isn't back up to full capacity after those 8 weeks. You know, the questions are, do you have to continue to keep your employees on, you know, post those 8 weeks, as long as you use the money, you know, during those 8 weeks to spend on them? And I'm not sure, Maggie or David, if, you know, you want to chime in on answering that or what your thoughts are.
I can jump in. This is Emilio. There's no requirement for you to hold on to the employees. It was an 8-week, keep as many people employed or re-employ as many people as possible. And based on the absence of the language, either in the act or in the guidance since then, that, you know, speaks to that. There is no language, there's no restrictions. And therefore the unfortunate reality may be that some employers really were waiting on this cash to re-up employment. And now that they've used the cash during the 8 weeks to pay for their employees, if they weren't able to open their doors and bring in revenue, we may be looking at a significant relapse of unemployment after the rolling 8-week period, because it's going to be a rolling week period, because every applicant has a kind of a different start date to the 8-week period. And so, and if I can use that as a kind of a sounding board to speak about the incurred and or paid concept, obviously the biggest chunk of qualifying for forgiveness is payroll. And that is something that our clients and our listeners can control to a certain extent. Even though I don't believe, and the firm doesn't believe, that it's going to be a hard and fast 56-day rule, that if you got to spend every dollar that you can on payroll by the 56th day of the 8-week period. We don't think that's going to be the case, but even if that became the case, then you got to talk to your payroll companies. If you're doing your payroll on your own, you got to run the math, you got to do the analyses to see how you divvy up the money, if that's the plan, to get as much forgiven as possible. So that's my take on looking at where the opportunity is for forgiveness. And obviously it's in the payroll, and to a certain extent, there is something that can be controlled during that 8-week period. And if it does work out to be the payment, then you got to figure out how to get that payment process within that 8-week period. We are of the mindset that if the 56th day of your period, of your covered period, ended up on June 12th, which is a Friday, and your payroll was actually due on June 15th to your employees, that's when it hits their paycheck. We think that if you process your payroll through Paychex or through ADP or through whomever on your own on June 12th, Friday, that's going to be good enough to get you that expense on the forgivable side of the ledger. Okay, with that, I'll mute and turn it back over to David and the team.
Yeah, just to elaborate on two things on what you just said, Emilio. Maggie and I went through this the other day, actually. The payrolls, weekly payrolls and biweekly payrolls, are probably not going to be so hard because you'll get 8 weeks within 8 weeks. However, be aware, anyone who's on a semi-monthly, 15th and last day of the month, we actually walk through it. And timing-wise, this is where you may want to look at your calendars. There are scenarios where you might only end up with 3 payrolls within the 8-week period, and not 4. So that might be one of those accelerated things Emilio just talked about. The other thing kind of Jordan alluded to too is I may get to the end of the 8 weeks for forgiveness, but I may not have spent all my proceeds. Remember that use concept we talked about early on today. I have to use it for those certain expenses. So I may still have unused money if I didn't bring back a lot of people. So I may still have to continue to either, if I don't have those non-payroll costs, I may have to keep paying some salaries just to make sure I expend the money. I don't think it's going to be a problem for people, but conceptually you might have money left to spend after the 8-week period.
Yeah, one idea that we bounced around internally, and it's a crazy idea, but for that semi-monthly employer, even for the biweekly, because depending on when you get funded, that starts that 8-week period, and that may not coincide with your weekly or biweekly payroll drops. We've actually talked about having our clients call their payroll processors and say, okay, as of this date, as of the date of loan funding, I want to go to a weekly. I want to go to a weekly payroll, so I can make sure that by the 56th day, I'm at the end of my 8th week payroll, and I maximize the amount that's paid. So when you think about making these suggestions to clients, you start wondering, it's not practical, and therefore we really hope that there'll be clarity provided over the next couple of weeks on this. David, I think we can go on to the non-payroll cost questions.
Yes, Emilio, we'll get there right now. I just had one other comment because I saw some questions come in. I think Maggie may have touched on it, but there's still, we assume a lot of people are asking about replacement employees. My employee didn't come back, but I replaced them. And am I going to be able to use that cost? And am I going to use that employee for not having a salary reduction? We believe so, but again, we're hoping that guidance will actually, stipulate that you can replace, the replacement employee counts in all of this. So going into the non-payroll items, and again, this is again back to the chicken and the egg, paid and incurred, or paid and or incurred, right? So when we talk about things like rent, I may have rent that I paid, that I didn't pay before the period, and now I have the money, and I'm going to make up my back rent that's already due to the landlord. Or maybe I want to prepay my rent because I need to pay some more expenses. Again, the back rent being paid in the period, we think so, because you're actually making the payment in the period. Prepayment, may actually even default to what the lease says. Again, this has to be an obligation that was already in place. So the lease language may play into this. So again, a little ambiguity there, but we think that hopefully that the guidance will come out pro applicants to help them get the maximum forgiveness. And again, with the lease, does it need to be in writing? A lot of related party leases are not actually in writing. It's unclear, but again, the hope is there is other types of proof that an obligation existed prior to February 15, 2020. If it's a related party lease, you've probably been paying that lease religiously every month, and you probably have a general ledger that shows your rent expenses, year after year. So we're hoping that type of support will be allowable for rent expense. So with that, I don't know, Jordan or Maggie, any comments on non-payroll before I move into the next slide with some other issues?
No.
Other than
Okay.
I just think documentation is key. Just be sure that you have the documentation lined up and ready to go before you start making these payments on those costs.
Exactly. That's a good point. And that kind of feeds into the first question on the next slide. Do I have to segregate things? Do I have to have like a whole different payment system? Do I have to have a different bank account to pay the allowable costs that are allowable for forgiveness? And the answer is no. There's nothing in the guidance or in the act that requires separate accounting, separate tracking. So I was on a webinar, I was listening about a week or so ago with the regional director of the New Jersey SBA. And he actually said, they believe that most accounting systems that people have in place, that their general ledger systems, their accounting systems will be able to extract the information needed to track these costs and support the money was spent. Now, there may be some special circumstances where you may want to put the money in a separate account, or you may want to create some sub-accounts in your general ledger just to make it easier for you to pull it out. But the overall answer is there's nothing that you need to do in addition if you already have a good set of books and records. Payments post June 30th. Again, we're of the opinion that 8 weeks is 8 weeks. If 8 weeks goes past June 30th, it's within the 8 week period, it should count. If you still have money to spend, even though you might be beyond your 8 week period, it might be post June 30th. You should be allowed to spend that money. That's the way it seems to be, the intent seems to be.
And let me jump in here, David, a second. If you think about it and the prognostication of how quickly the next 310 billion is going to be utilized or evaporate, it's probably going to happen before April 30th. And if that's the case, it should make the June 30, hand-wringing moot per se, because you're going to have more than 8 weeks, all the way up to June 30. So I just want to add that.
Good point. That's a good point. So I just want to touch a little bit. The next couple of questions, or the next question comes a little bit from the April 14th guidance, where we got some more insight on self-employed and independent contractors. And, you know, we talked before about people getting 100% loan forgiveness, but in the case of a self-employed, the new guidance makes it virtually impossible. I think it's mathematically impossible, actually, to get 100% loan forgiveness. If you think about that self-employed person who now has to use line 31, their net income from their 2019 Schedule C, limited to 100,000. Well, they applied 100,000 divided by 12. We've done this numerous times. Times 2.5, they were able to borrow 20,833. But now think about forgiveness. They have to start with that same number, 100,000 divided by 52 times 8. That's our now famous 15,385 maximum payroll costs. Even if I have rent and utilities, let's assume I have no employees, but I have rent and utilities deducted on my Schedule C, I have to gross up the 15,385 to make sure that I have no more than 25% of non-payroll. Well, that grosses up to only 20,513. My maximum forgiveness number is 20,513, which is lower than 20,833 that I borrowed. It's minimal, but it basically mathematically says no self-employed will ever get to 100%. Now, if they have employees, that's a different story, but a self-employed with no employees, I think, is going to be limited. And then finally, I'm going to end the formal part of the presentation with the fact that somebody along the way failed algebra. So unfortunately, in the current wording of the Act, when Maggie walked you through the forgivable expenses and multiplied by the FTE calculation, you know, the presumption is if you ended up with 100% of your FTEs, no FTE reduction, you would have no reduction in your forgivable expenses. However, the language actually says you take your forgivable expense pool and you multiply it times the FTE calculation, times that percentage, and that gives you the reduction amount. So if you think about having 100% FTE ratio, and I multiply 100% times my forgivable expenses, and that equals my reduction amount would be 100% of the forgivable expenses if I kept everyone. And that obviously is not the intent. There should be a reciprocal. It should be 100% minus the FTE calculation, then times the forgivable expenses to get your reduction. But that wording has to be fixed. You know, so I think that's more of a just kind of the proof of what everyone's been working with and going through over the last several weeks, trying to get everything lined up on all these programs.
David, you did a great job of getting through those 15 questions. I know Jordan's compiling a couple of them with common themes. I have one or two that I think apply across the board. The first one is related to partnerships. A lot of our clients and listeners are in a partnership solution where there's a couple of general partners. And in certain cases, some of these partnerships applied before the April 14th guidance. And by doing that, they did not include the general partners in the application of the partnership towards getting the amount of the loan. And so they kind of undershot on the loan end, because now the rules say, and this is important for everybody to hear who hasn't applied yet that's in a partnership, that the rules now say that you must include those GPs, and we think it's individual GPs, into the math to calculate the 2.5. So in certain cases, we have clients that applied beforehand, and in a couple of cases, we have clients and listeners who, when they applied, did not include the healthcare and 401k piece either in their loan amount. And now the 8 weeks has started, they've got their loan funding, and they are going to pay the healthcare and 401k match on their employees, and obviously they're going to pay compensation to their GPs. So it's a two-part question. The first part is, will the healthcare and 401k match paid during the 8 week period? And I'm going to answer the question. That should qualify as forgivable expenses, notwithstanding that you didn't ask for it as part of the loan. What I'm more curious about for the group and for the listeners is, what's our take on whether the compensation paid to those GPs during the 8 week period should now qualify as a forgivable payroll cost? I know it was a long question. So I hope you stuck with me. Aggie? David? Hello?
Sounds like you stumped the panel finally, Emilio.
Oh, okay. Well, I think our initial reaction, because we've talked about this internally within our PPL loan advisory team, is that go ahead and ask for that portion of the GP's, the general partner's compensation as part of forgiveness, under the notion that had you applied after April 14th with all the information you had, you would have included it in your loan ask, and therefore you shouldn't be penalized, and you should be able to have that forgiven. But in this case, unless there's guidance forthcoming, we can only try to be as assertive and proactive for our clients and make the ask and try to maximize the loan forgiveness amount. Jordan, do you have a couple questions that you want?
Yeah, there's two quick things that I saw multiple people asking about, so I think we'll just try to go through them real quick. I know we're at 3 o'clock, so just bear with us another minute or two, or feel free to drop off. But people are asking, can you delay the 8 weeks, the 8-week clock, if you will, once you receive your money, or can you delay the funding? And the way the act reads right now, no. The answer is no to both of those. I mean, once you get funded is when you're funded, so you get that money, and the 8-week clock starts ticking the day that you get that money. So the way that things currently read now, unless there's further guidance that, changes that, you have 8 weeks to use that money for purposes of, obtaining maximum forgiveness. And then I think this kind of plays into the next, question is, what if you don't use all of the money during the 8 weeks? I mean, that's okay. If you don't, if you can't use all the money, or you don't want to use all the money during the 8 weeks, all that means is that you're going to have a portion of the loan that you will potentially have to pay back. The 8 weeks is the clock for the forgiveness uses, remember. So you can still, use the money beyond that 8 weeks. It won't be forgiven. You'll just have to pay it back at, the 1% interest. So I think those are two things that, we just want to clarify. Multiple people had questions on them.
And there's no prepayment penalty. If you want to pay whatever you didn't use back immediately, you can do that. So we are at 3 o'clock. We've received over 200 questions. We will do our best at compiling the questions, providing answers, and providing and summarizing them into a Q&A that we will then distribute by email. I'd like to thank everybody again for joining us today. We covered a lot of information and hope it was informative. I also want to extend a special thank you to our panelists, David Evangelista, Jordan Argiz, and Maggie Reach. Stay well, be safe, and strong. Bye-bye.